Hello, guys.
Hey guys, how are you?
Doing great.
Doing great as well. Ready for another massive day. Massive Wednesday, huh?
Yeah.
Do you guys have a PowerPoint or we're just gonna take it?
I think Schreier has this. 1 second.
Mm-hmm.
Okay, let me see. I can pull up, but I need to drop off at like 6:40 at the latest.
Me too.
Okay.
And Sanjay, do you remember I'm coming to Dallas next Monday night? I don't know if you can go.
Oh, this Monday you're coming?
Yeah, it's the old Capitol.
Okay. Yeah.
If you can.
Yeah, we should.
I mean, it's good for your image.
Sorry?
I'll introduce you to lots of people hanging out with me. It's good for your image.
Yeah.
Are you guys gonna be in Dallas? Because there's an investor who wants to meet us, so I'll for sure.
I'm going to the old Capitol event.
Okay.
They have a speaker series, and I try to get up just because I meet everybody there, because it's not like like everybody comes, like, because it's not like a Sunrock event where only they come or whatever.
Okay, but you guys are not hosting like any meetups or anything?
No.
Okay, gotcha. Should we start letting people in?
I think so.
Yep. All right. Let's go.
Yeah, but it's gonna be, can't just do it that way.
Okay, PowerPoint on my side is still coming up.
Hello. Good afternoon. Welcome in. We're about to start.
We'll give a few more minutes.
Mm-hmm.
Hey Sanjay, hey everybody.
Oh, hey Shar.
Hey. Mike joined too? I thought he was busy today.
So several people are saying their link's not working.
Oh, really?
Oh. Yeah, because usually we have a lot more participant by this time. Hey Jasmine,
Sanjay.
you're replicating.
Oh yeah, I was trying to. Okay, I was trying to see if that link is working. So it worked. I'm trying to find out what's going on.
Maybe that one was.
Hey Shar, what were you saying?
I said I had the conversation with Walker Dunlop. They came back and said the leverage, they're challenging the tax rate that we have. their tax rate's
Okay.
coming up to be about 30% higher than ours. We'll go. It's
Oh.
interesting. At least it's happening now than later, right?
Yeah. Welcome, everybody. We are just giving a couple more minutes and we'll get started.
Lots of people are still saying, I sent the link that I used to get in out, but there are people saying it's not working. I mean,
Okay, let me. I'm sharing my screen. Let me know if you can see it.
Yes, we can see it.
I'm missing
Trevor,
the
I-
visit. What's
Trevor,
up?
yes, sir.
I just used that link. It worked fine to come back
Okay.
in. So
Diego said the link was stating no longer accepting registration.
Mhm.
And Brooke said many people can't get on still.
I couldn't get on either, even after I re-registered. I went onto that link, it made me re-register with all my information, and then it blocked me off. So we might want to publicly share an updated link outside of WhatsApp.
Oh, Natasha said the same thing. Her link did not work, had to type in the numbers.
Oh, technology.
Live and learn.
It's amazing when it works.
Yeah, I know. So I just shared the links away as much as you can, right? No sweat.
yeah,
Couple of more
Yeah,
minutes,
the
we'll get
one-
started, right?
the one you sent, Trevor, worked fine. So if people are asking, that one does work. Share it in the share it
I'm
in
gonna
the chat,
share it here. Yeah, I'm gonna share it
and
here.
then people
so-
can send it around.
Mhm.
Yeah, I think there is maybe related to browser. I have to literally give the link in the Zoom. It worked. So for just clicking in the browser, sometimes it's not working.
Hey VP,
That's such a big team.
hey
Master
VP.
Yeah, I couldn't get in until I found the link from last week. The one that Trevor keeps putting in chat doesn't work for me.
Oh,
Sorry.
weird, it
So
worked.
I think this one that I just dropped on the chat is working just fine. I just check it. It should be. If you guys can share that around with people, that would be great.
Yeah, and that one for me just goes to registration is closed.
This one that I just dropped.
Yep.
Yeah, sometimes.
Ugh.
I had to go to that to get in.
the new link is working.
Okay.
Odd.
All right.
All right.
Okay. Well, that's good. Oh.
They have a big team, man. All we need is a big team. Massive cap.
Oh no.
Okay, I think we should get started, Shai.
All right, sounds good. And I was talking to myself for the last 2 minutes or so because I was on mute, didn't realize.
Oh,
All right, let me get started. All right. Okay, you guys know us already. This is Massive Capital. And so just as a just like any other webinar, first of all, thank you guys for making it, especially folks who are in Houston. Temperature went from a 75 or so, 70 something to a 50s. It changed within last 3-4 hours. So it's cold outside, but thank you for joining this late in the evening. So the topic for the webinar was really it's us to understand a little bit more. Hold on, I got the wrong slide on it today. I'm in all over the place. It's going to be the NMHC reflection. So that was the deck, and that was the agenda for today. And so before we get into the whole slide deck, we'll talk about a little bit about us and what we do, and then what is cooking in our pipeline, and we can go from there. All right, so Massive Capital, you already know us. We don't have to talk about it a little bit more. All of us here, we have me, Sanjay, Mike, all the partners, and then we have Jasmine, Trevor, Maria, Ramiz is out today, Bhaskar is out today, also have Candias. And we have a couple of new members are joining or joined with us. We'll update the slide deck for next webinar. So I believe we are almost 10 members strong at this point in time. Right. And what we do, we buy land for new development, and also we buy value add class B and C. And we look at A's, which is coming out the new construction as well. For where we don't have our footprint on, we partner with local operators. And for land developments, we also partner with land developers. We try to come in, bring the balance sheet for the debt, earnest money, and also an equity needed for the project. So that's in one way to take a look at it. We add value for our partners across the value chain, from deal sourcing to PSA. Anybody needs some help with putting the team resume together for LOI, to PSA, to contract negotiating, we can help. Then earnest money, loan guarantor, debt. We have a pretty good balance sheet partners. Our relationship with the debt partner goes a long way, and also LP equity and JV equity and asset management. So at the bottom, in general, if you're a local operating partner, where you own assets locally and you are trying to do a bolt-on acquisitions, yes, you can find a team. We can get you 1 or 2. But if you're looking for a reliable team, we can support you throughout the way. Please come talk to us. And same for the equity partners. If you look for one team to have deals continuously coming in, it's there. And for the LPs, we always say underwrite our process before you invest. So you don't have to go deal by deal. It's about the in general investment hypothesis and the philosophy, and then we go make a choice, right? Sanjay, you want to add something to it? Are you fine?
No, that's good.
Thank you. Our current activities on the right side is a snapshot of our deal chart. I think we typically try to keep about 14 or so in underwriting, but still we high graded that asset that we take a look at it. As of now, we have 3 assets under contract. We have 1 LOI pending and 9 assets that's being underwritten. We are starting our fund. Fund framework is ready. So as soon as you find the right project, we'll
See you all later.
Bye. For investment opportunities, we typically try to buy 2 to 3 opportunities every month. So we have a quick plug. We have a 506C new development project in Georgetown. That we had a webinar already last week. We'll have another webinar next week. I believe we're about 70%, 75% done. So if you're looking for a land play, 506C, it's a 20% IRR, 1.4x, 7 pref, 2 years in and out, 70-30 split coming up. Please, it's on our website. We also have another one. It's a top secret project. Can't talk about it. It's a 506B. On that note, full disclaimer, we're not attorneys. We're not CPAs. What we talk about is our reflection on our opinion. Make your do your own due diligence and cautiously and consciously make investment choices. We also have another value add. Can't really talk about it. It's secret again. So reach out to one of our team members if you wanted to know more. In general, we bought last year. We finished the year with a little over 900 doors, $106 million of the assets, and we are continuously looking for assets as well. And we're looking at across all the asset classes, and those are the locations that we're looking at. In general, we don't go into a market where we, as a collective team, do not own assets, because we believe, a new team from Houston partnering with new team in Seattle, going to new place in Milwaukee and buying a project puts us a lot of risk. So we try to mitigate that by having local partners there. All right, NMHC reflection. And I see Frank. Frank, I'll tag you in as I go through it. And so thank you for joining as well. But Frank is one of our partners. Him and I spent about 3 days very tight together, and we had a pretty interesting time. Right. So what we're going to talk about, so our objective is to share what we have observed and derive from the NMHC, and from the buyer perspective, from the broker perspective, and from the owner perspective. And we'll explain, what we heard and what we think behind the pictures, right? Because when we hear someone's making a comment or a statement, it is important to understand what they're saying. It is also important to understand why they're saying what they're saying.
Why do we need to know this? The reason we need, if you
Could you go on mute, please?
dashboard, why do we need it? We need to have an idea.
All right. Okay, thank you. So on that note, I think from our objective is to explain what we understand and why we think it is. So when you and hear us out, then you can kind of make a conscious choice as well. So we shared this last webinar, and just to kind of share what our opinion is, that when we look at assets, we look at 3 different categories: global macro, then US, then the state. So the way we believe is that supply chain and the Russia-Ukraine war and the US-China decoupling, US-Iran relationship has an impact on how the global market sets the stage. So I'll go from bottom up. The oil and gas price should stay steady. So if we have assets in the oil and gas heavy area, such as Houston and Oklahoma, they should stay steady in terms of revenue perspective. US-China decoupling has tremendous impact in Texas. We have impact especially on in the Austin area and also in Dallas area, because the high-tech manufacturing is coming up. So think about Taiwan, right? The whole fabrication there is coming to US, especially at the top end of it, just to kind of keep it inside. China COVID, it's in a better spot. So by Q3, we were expecting everything to come onto the more of it, I would say equilibrium price. And the worst part that we have, it is open, is the US-Ukraine war. When I looked at some of the trading numbers, we're thinking on a Q3 we'll have some resolution, but who knows? And I think that's going to set the stage how long the higher interest rate will last. And then from the US perspective, so we believe interest rates higher for longer. And last week we mentioned that even though market is saying, pricing in that the first dip should be end of the Q3 or 4 this year, but now what we understand that may slip by another quarter or so. So we are taking a position that we should see a first dip on the interest rate on 2024. That means next month we'll have another increase, and that should be the top, but they should stay a little bit longer. So it's a 70% chance they're going to take a dip in Q4, 30% chance it's going to slip to 2024. So it's easier to plan for 2024. And web tech and AI, we have a lot of impact, as you can see, but it's this recession, it's not for the bottom layer of the economy, for the earning revenue perspective, it's at the top end of it. Folks who are making 6 figures and higher, working in a high web tech type role, they have the layoffs, and jobs are there, may not be the same pay grade and the same domain, but it's there. So it's to us, it's a recession on the top end of the economy. Lending and real estate, still available, very less. It's a deal by deal basis. Everybody's there to willing to spend the money out there. Micro, we're not going to get into it. So that's another session. We'll have more webinars coming up to share how we understand about the different local states. All right. Next one. So NMHC for grounding. This is where NMHC kind of go in. Just for grounding, it's NMHC's National Multifamily Housing Council. It's a conference for senior players, large operators, senior, large, and nationwide operators. It's a highly concentrated by developers, general contractors, service providers, lenders, insurance, and owner-operator. This is extremely, we had about 8,000 people or so. They showed up and everybody came together for 2.5, 3 days. They came in and they left. It was like that quick. It's literally Wild Wild West. When you go in, if you don't have a scheduled meetings, if you don't know who you're gonna talk, it is tough. It was crazy. I don't, David was there, then a couple of people died. It was just mad crazy. That's all I can say. But on the flip side, it is very intentional that if we have planned to talk to certain people, to schedule certain things that we haven't met, they live in California, we live in Florida, hypothetically, that's where everybody will come in and you can shake hands. So it's a pretty interesting place to go. What did we expect going in? This was our first NMHC, if I can flip the numbers right. And we had no expectation in general. We want to go in and kind of sort of see how the whole thing kind of plays out. And then we were focusing, we had a slight focus on the lending partners who are used by the large operators. Let me take a pause and repeat that. We wanted to focus on lending partners who are used by the large operators. Typically, large operators will be, 5,000 units or more. They have been in the game for a decade. They started around or before 2008. So they have an idea what the downturn would look like. And I wanted to see how they kind of go about it, right? That resulted all the people I met personally and had a conversation, but 17, 18 of them. So I kind of ranked it: L for lender, B for brokers, S for service providers, and O for operators. I met CEO of Graysteel, Ari. I had a conversation before this session, then I had a conversation, we shook hands and talked a little bit during the session. We spent quite a bit of time with Meridian twice, 2 days, about 3 hours. We spent about a couple hours with one of the focal point from PGIM. And that was an interesting startup. It's called G Parency. So they were a lender, but they're a flat fee based lender. So instead of paying whatever percent you want to pay, they work on a subscription model. I believe $5,000 a year, then 16 grand or 11 grand per loan. That is it. Interesting play, but hey, this is like the flat fee type brokerage. They have flat fee insurance, so it's pretty interesting. And then we met the man, Paul Pibble from Old Capital. I spent quite a bit of time with them. Then we met a broker from Barclays and Millichamp, and then we had a small hangout with the EVP of RPM Living. He runs across the Sun Belt. Then we had dinner with Brad Shamrock. And on our way meeting up with PGIM folks, we caught up with the senior VP of Toll Brothers. He has some interesting comments. And then I followed two senior operators. One has more than 7,000 units. Another one has more than 12,000 units for half a day, to tie it into the number 3 here that wanted to see what they do, right? Then I caught up with a couple of Jake and Gina folks, and also Brad Samrockers were there as well. This was an interesting, packed day there, and pretty high level conversation all the way down to low level. Means that operator geographically located versus all the way up to the CEO level from the Graysteel, where he's looking at, and across the US, all the fundings and the brokerage and everything else. Again, if you guys have any questions, please drop a note on the chat, and we'll catch up, or feel free to ask as we kind of go. Okay. All right. So what we understood. So again, those are our opinion. And I heard some of those lines line by line. So I wrote it down. I tried to write it down as much as I can remember. So from the lender perspective, what they're saying is that not that many deals are penciling out for high leverage debt. So 55% is still there. And what it means is that you can see on this social media, Facebook, LinkedIn, that Freddie and the agency debt are still there, and they're hungry, which is true, but not quite true. Agency always has been there for lending, as long as we buy on a T1 to T3 basis. That means if that, the DSCR checks out, they're going to give you the loan. We just haven't used it because majority, almost 80-90% of the asset we bought, or everybody else bought last year and a half, was on a pro forma basis. So they're out of the agency debt. The agency has been there as a steady state, as a reliable partner all the time. We chose not to use them because the market was asking us to pay more than what they would give us the loan for. That means if that deal pencils out at a 1.25 DSCR, loan is there. Lots of cash flow negative deals are out there. They aren't surfacing. I see it on a personal basis, and lenders see it. And because a lot of people reach out to them for refi, for sale, for loan sizing, we just aren't surfacing. Because if you think about it, if I'm a broker, am I going to go back to a seller which I sold the property for $20 million, the value is that's $16 million, and ask them to sell? It's a slippery slope. So there. Then from the servicing perspective, every loan has a DSCR requirements. So if you want to see a cash flow negative, secondary layer DSCR, so there are lots of projects, DSCR requirements are not met, especially for the assets 2019, 2020, especially when rate cap wasn't required. On top of that, assets with the rate cap expirations are also in trouble because the rate cap coming in was expensive, but the same amount of rate cap now is even more expensive. Good thing is all GPs are fighting. Everybody is fighting every single way possible to float the deals and extract the most out of it. On the other side, lots of capital are on the sideline. What it seems to be that everybody's waiting around the Q3 and to see what the market settles. So in general, the idea was that the highest amount of rate increase happened. If it happens one more time, we'll accept the new reality, and then we'll float through a little bit, and then we'll go back to the transaction mode again. So Q3, Q4, it's where we think some actions were to happen, but lots of capital out. Everybody that I talked to from the lender post, I have money, I have this, we have that, but there's no deal. So it was interesting lender perspective. Second one is the broker perspective. It gets really, really interesting. They're saying that assets with the very low interest rates are being exchanged, which is true. So think about, I don't know how many upstream oil and gas folks we have here. So when the time is bad, you tend to sell your best assets. And you'll see it, why assets with low interest rates can be exchanged. Because if an asset has a lower interest rate, inherently that is valued more than an asset with a higher interest rate because you're making more money, right? Your OPEX is low and the NOI is high. This was an interesting comment, number two, that the broker community will shrink because this is not going to happen with the volume, not enough money to be made. Some brokers will go. So as an owner operator, keep an eye on that one. I was like, that's interesting. Third thing they said, the buyers and sellers spread will always be there. Good times or bad times, their spread's going to be always there. And then we have to make a conscious choice what it is. And also they mentioned, there was another broker said that sellers are getting realistic a little faster, the negative cash flow. It's like, traffic ticket, right? I want to drive 90. I get one ticket, no big deal. I get 3 tickets back to back. I'll be driving at exactly 65 miles per hour to the T. This is very similar to that. If the project doesn't cash flow 1 month, 2 months, 3 months, month number 6, 7, 8, if the pocket is not deep enough, it's time to come to senses. So it's been interesting. And again, they're saying in general between these two, it's that there are a lot of assets coming up to be due for refi and things like that. And, so it's going to be interesting how next 6 to 8 months kind of plays out. Last one is the operator perspective. Insurance is hurting everyone. 20% plus increase in some cases, upwards of 30%. Taxes adding salt to the wound. It's not even helping either. FD cost is there, and it's going to be high. Tax and insurance are causing major issue for refinance even after revenue growth. That means we execute the business plan. My revenue is at par. I underwrote it hypothetically as $1,000 insurance, but I'm paying $1,500 now. Lender is using my $1,500 to underwrite the deal. My NOI growth got shrunk. For same LTV, I'm not getting the amount of money I can get or the valuation can get, right? So it's an interesting time. Put together, people are, even though it sounds negative, but put together, everybody was very optimistic that we are on the worst part of the cycle is behind us. Now we just have to survive and to float another year and a half, then it's gonna get better. So that it's looked like lots of buyers, everybody's a buyer. Sellers are less, which is number 5 here at the bottom, all GPs are fighting. So it was interesting, really cool conversations to go back in there.
Yeah. And can I add something here?
Yeah, please.
Yeah. So, so these are the comments from the world out there, and on our own deals, what we are seeing in the last 2-3 months, there are so many deals that we have underwrote, and we just didn't even make an offer on those because DSCR is not met, right? The cash flow just doesn't meet. So, there's nothing we can do if the DSCR is not met. Similar to that, in the last month, from Massive Capital, we bid on a deal, a $92 million deal, Greenview, Class A, brand new asset here in DFW area. It had a assumable loan at 2.9%, still 7 years IO left. That one had a lot of interest, and so much so that our offer, Massive Capital offer, was higher than the offer that seller ended up accepting, but the offer that the seller accepted had a $1.2 million hard money on day one, just because of that low interest rate, right? That we're talking about here. And the same broker had another deal that I walked today here in the DFW area, close to UTD, University of Texas at Dallas. And that has a loan coming due soon. It's got a new loan. And the broker said, hey, take this one. I don't have much interest on this one. Just that the low interest are being exchanged. The asset with low interest are being exchanged, right? That we're seeing that in real time, live, and quite honestly, if you can make an asset work with today's interest rates, you only have an upside from here, because interest rate, especially in our opinion, are almost flat, maybe one increase and then flat for a while, and then it goes from there. So, if it works in today's interest rate environment, it'll only get better. Interest rate goes lower, you refi and cash out. Interest rate goes lower, your cap rate also drops. So things will get better from that perspective. So back to you, Shar.
This is good. That's a great comment, right? So let me kind of build up on that. Why we're looking at value, right? Because in general, when we buy an asset at 3% interest rate, hypothetically, and then we're going to sell tomorrow to Sanjay, and he's going to pay at a 5% interest rate. What's going to happen? We have to work for free to increase the valuation from a 3% interest rate to a 5%, and then work double to increase economic value. So that means that anything that has a short cycle left, like a 3, 4, 5 years left, that's a risky proposition with the low interest rate to come in. But if you have 7 years, you have 8 years left, oh, that is fantastic, right? That means I can operate my business plan at a 3% interest rate. 4 years down the way, I can sell it to Sanjay. He's still going to pay me at a 3% interest rate because he has 4 years left. He can execute his business plan. So we can go through the hand twice, and then we can sell it. By that time, 7 years out, market is going to be somewhere else that we don't know. So it makes a lot of sense. You have a lot of breathing room. So watch out for anything short term coming up, 2-3 years of those are short debt. But if you have a long one, makes a lot of sense to buy, right? So that's where the lower interest rate with the longer runway has a lot more value than something with the shorter timeline. And also on the other side, what we're talking about, we want to pay as high of interest rate as we can get away with, because we are on the side of the market. So as the market turns, we're in a better place, right? So if a project underwrites on a bridge debt in today's market rated product, it makes a lot of sense to buy it and just avoid those low interest rate that has 3-4 years left, because the refi may not happen that quick. Good point. So again, for us, when we capture the data, now the question is us, we as a buyer, we got to flip it on the other side. So we'll talk about it. But in general, banks are out there, pref equities out there, retail equities out there, deals are not penciling out. But if a deal pencils out today, whoever goes there first, they will take it. And I believe one of the buyers who came and bought the $90 million deal, there's going to be institutional buyer. They have a lot of cash. They have to deploy. Their play is you buy something at a 5.25 cap, all cash, and you float that deal for a year and a half, 2 years, and you refi when the agency debt drops lower than 5%. So they made the money just because they bought it and waited for a year and a half. That's a larger play, that interesting way, and others are buying assets. In other words, deals are happening, just not by the brokers who send you an email blast. Probably it's not going to happen, but on the back end, lots are happening. Okay. And then I said, okay, those are my comments. Maybe I'm right, maybe I'm biased. I have my own bias, right? So I went to LinkedIn and I took out some of the snippets. Full disclaimer, those are publicly LinkedIn information. I'm kind of sort of connected. I try to pick up anybody who's on a second, connect. So try to be unbiased, and I highlighted them. So I saw this comment from James, Browser Residential, they're pretty huge. And he kind of left a comment where most are going to wait and see what happens to the second half of 2023. And many are planning to do it 2024, which is very similar to what we're thinking. And then second person, he's from CBRE. It's a big one. I just highlighted a little bit right here. He says, we do some activity, the horizon third in the fourth quarter of 2023, which as we talked about. And interestingly, he also talked about this, that the value is in the debt, where a buyer can assume the loan at a better interest rate than the market. So we have some data points to kind of, now I did not go intentionally, pick it up. I just went to LinkedIn and typed NMHC, look up my first connect. I took a snapshot of the people I don't know. And then the last one is the rescue capital. That is true. We're not talking about it by rescue capital. The back end deals are still working out. So there's this too. Then I went and I selected one more. Go ahead, Sanjay.
Sorry, one thing I can add here. On the loan assumption, we've seen some of the deals in underwriting. Yes, the low interest rate is attractive and great to go in, but the yield maintenance, which is very different from prepayment penalty. Prepayment penalty is a stair step 5%, 4%, 3%, or 765 straightforward calculation. You know how much it is. Yield maintenance is based on the interest rate movement. And so, when assuming a loan, you have to take that into account, that if the yield maintenance is there for the next 15 years and you plan on exiting at 5-year mark, your interest rate is low, but for exiting, you're going to have to shell out $1 million, $2 million, $5 million, depending on the size of the deal. So that's a critical factor to keep in mind, and on all the loan assumption deals to look at.
Thanks, Sanjay. This is, 100% agree. 100% agree. I mean, on that note, just to kind of full disclaimer to everybody, we tend to geek out a little bit. So if any terms are not known, if another side conversation is always welcome. So we come from finance background. We love it. Structural finance is fun. We'll talk about it more as we kind of go. So then another one, and this is George Smith Partners. They posted a big deal. I mean, I kind of took it out. They're right. This is kind of interesting. They're underwriting 5 to 7 years agency at a 5.25 to 5.7. But remember, there's another little bit hike coming up, right? So that's there. And they're saying the price needs to be adjusted 10 to 20%, which is in real life. A broker comes up with $10, a $10 million asset, it's coming up between a $8 to $9 million valuation that's coming up today. And the capital providers, he kind of hit it, is that equity groups have started programs to deploy pref for refinance and acquisition and reconstruction loan. So it is going to be extremely important. The most exposed are the constructions coming up due. Second exposure, it's going to be rate cap expiring and or breach is expiring. And third exposure, if we have some more room, which is the short-term debt, fixed rate, kind of continue with it. Then I have another gentleman, Dane. I laughed at it when I saw it. 90% of the market is buyer, and it's picking up in the Q2. But I mean, the reality is everybody is a buyer. But also the reality is not every buyer can buy, even though you give them a deal, right? So true buyers are very less. And it's just like everybody who's been in real estate for the last 20, 30 years, we always heard outside the US money coming into the US, just like that. There's never a buyer's market, there's never a seller's market. As long as it checks out all the assumptions, again, these are all commercial assets, right? Our feelings don't care. As long as we can improve the we make an offer, right? So I think that buyer-seller spread is always going to be there. Market's going to swing either way. So to me, buyer's market, seller market has a jive to it, but in a buyer's market, equity is tough, lending is tough. On a seller's market, it is equity is tough and lending and your loan is tough as well, right? It's a lot of risk that we have to balance. What else? Okay, so that's all I had. I think I meet that 6:40 time. I tried to go as much as I can. So it's Q&A for 20 minutes. So, hey, let's go through the questions and then see what we have.
So maybe if we stop sharing, it will pop everybody up.
Awesome. Let me stop sharing. I think I stopped, right?
Yes.
Okay, good deal. Thank you. Thank you, Trevor.
So Shreyer, there is a question here. Is it a buyer's market if we're saying there are a lot of buyers there? You referred a little bit, there's not really a buyer's or seller's market. Can you talk about this a little bit?
Yes.
Is there a buyer's
absolutely.
market? Will there be, or what is that situation?
So the answer is it is, even though they have a lot of buyers, but not all the buyers have the capability to pick up all the deals that they want to get. So it is leaning towards a little bit of buyer, but sellers are also fighting, right? As I mentioned, everybody's trying. If I have a deal today, if we're hurting, trust me, we're going to fight. We're going to find every single way before they call it quits, right? And everybody just like us. So I mean, on the other side, it is true that if you have equity on hand, if you have right balance sheet, then you can lean the deal towards your way. Because in general, there is a strategy when you go through a down cycle. Again, down cycle is given. We all go through it. From the real estate, maybe after a long time. From the oil and gas, I've been through 3. And I worked with some of those high-level folks. Let's say I was here 2013, 2017, 2013, we took the unconventional portfolio. It's about $18 billion portfolio through 2 down cycles back to back. And what we call it is that in a down cycle, you must have your balance sheet. That means you must be lendable. Whoever has the balance sheets, they're going to survive. And if you have liquidity or your equity in this case, whoever has equity, they can move a little bit faster. And you build the team on a down cycle. So whoever has experience and a deep balance sheet and equity that they can deploy, they are by design and differentiated from the rest of the crowd to take on any deal that shows up. Hope that helped. Very good question. Very good question.
And
yes, Basham is awesome.
Any questions? I think you
Yes.
might be able to unmute yourself. If not, raise your hand and I can unmute you. We really want to make this last bit as interactive as possible. Don't all speak at once. I see it. Hold on.
Yeah.
You should be able to unmute. There you go.
Hi, can you hear me?
Yes,
Yes.
ma'am.
Okay,
Good
I have
to
a
see
very
you. Thanks for showing up.
thank you, Trevor. Very simplistic question. Thank you for all you've shared. For those of us who are relatively new to this, that haven't gone through as many cycles as you have, would your advice be to kind of wait on the sidelines? Because I think it's very challenging to try and underwrite things, deals, if we don't have the hindsight that some of you have. So what is your advice for those of us that are new, that are seeing, in air quotes, deals still flying around? Because I think at this point we're realizing they may not be deals.
So I have a different school of thought. So my school of thought is every cycle is a buy cycle, but how we buy it, they should not be the same way. When I buy in a high cycle, it should be structurally different than how I buy in a down cycle. That means how we structure the financing of the deal now, it should be dramatically different than how we structure the deal during the up cycle. That's a long answer. So you need to buy, you need to go make an offer. But again, what I would say, hang out with the team, build a team where they have more assets, they've been through a little bit, they kind of sort of got their skin knee a little bit, or knee skinned a little bit, and kind of build the team, then go with the team. Don't go solo. If you can stomach the risk, fine, go for it. If you can't, tag along with the team where, so they can give you a little bit more cushion as you kind of go. So short answer, tag along with the team. Long answer is he should go make an offer. Don't be gun shy.
Okay, good to know. Thank you.
Thank you. Balji?
Thank you. Thanks, Shariar.
Yeah.
Sorry, I'm probably killing your name, Shariar. So,
I apologize.
so I have one question, but kind of two facets. One is in this down market, how do you kind of build your investor base, particularly if you have a lot of accredited investors who has probably more in stocks? Any thoughts there? Once you finish, I have a second question. I will ask that.
What's the second one? Say it. It's okay. I'm writing it down, by the way. So
yeah, the second one is I feel, at least personally, it's a good opportunity to build generational wealth. Particularly, that's what I'm doing in a single family, where you go 50-60% cash and negotiate more. I mean, negotiate on top of the asking price. Maybe you remove your contingencies, whatever you can do, right? So similar to that, is there anything that you can do on multifamily where you have a clear strategy, particularly if you have a lot of equity?
Oh, those are some loaded questions. Okay. So I'll give you, again, everybody chime in from at least massive perspective. I'll give you my version of it, right? So first thing is how do you build your database on the accredited investor? So we believe, okay, it depends, because to a hammer, everything is a nail. And that means, what am I doing today? It's going to shape the stage, what I'm looking to get out of it. So I believe is that on the equity investors, they have different kind of problems, right? They're okay. Let me tell the story, then I'll go to answer. There are three kinds of money in general. One kind of money, they have to make money out of that money and have to eat out of that. Expected rate of return is highest, right? I'm investing, whatever return that I get, I have to bring food to the table. And the other one is I am diversifying. I have this, something here, something there. I need to add a real estate portfolio. I go invest. My expectation of that return is a little bit lower. And the last kind of money is that I sold something, I'm paying taxes. I had a business, I exited. I sold a bunch of stocks, it's not going to go anywhere. I have to get out. I would realize the profit. This is a take two where I protect my money. I have very little, I could get away with lower rate of return, right? So depending on your investor base, depending on who they are, it's going to be different.
Mm-hmm.
When you're a high earner, I mean, hey, you're paying 37% tax anyways, hell, the money is gone. Whatever you can save, that's just savings. So you don't have to get 25% return. You can go away with a 15-16% return, because your net is still higher, right?
Mm-hmm.
So that's what I would say. So don't go with the same message for investor base. Depending on your investor that you have, go whatever problem that they have, try to solve it. Right? When I hang out with my friends who does tech startup, I always say, they always say, yeah, real estate gets you the cheapest return. I was like, yeah, hell yeah, I'm not that crazy like you guys. That my money could go to zero tomorrow, but you can come back day after tomorrow 5x, right? Or money steady state. So we are complementary to your portfolio diversification, not a competition, right? So use that a little bit and see what makes sense. And the second thing, the generational wealth, man, that's a relative definition, right? When we started, all of us here, we need to define, at least we should define what the generational wealth means, right? Statistically, hypothetically, if I have $5 million, if I give it to my kids, it's not going to make a difference in their life. They're still going to go to college, go get a graduation. Yeah, they're going to be stupid around for a little bit, but it's not going to make a difference of 40 years of working life. Mm-hmm. They may have a nicer house, but if you have 10, 15, 20, then slowly started to change how they look at life itself, right? So when we have talked about generational wealth, I think everybody should have a definition around what is it, then you're suing against it. Couple that with, I think, earlier in the stage has a different kinds of strategy. Like to me, if you ask me, I go for multiples of the money, not for the cash flow. How quick I can grow the money, that's one way to take a look at it. But on the other side, we balance that with steady state cash flow, less of a return, right? So it depends how you're going to do it. But idea is that keep taking shots, ones and twos. Don't go for the home runs. Don't wait on the sideline. Take one bite at a time, you'll get the whole elephant. But if you sit down, time is going to come, time is going to go, right? That's That's a long-winded answer of yours.
Thank you, Shadi.
Frank, I forgot to ask you, man, how was your experience? Oh, Frank and I, we had quite a bit. You want to give your rundown a little bit? And Rishabh, I'll get to you after Frank.
Can you hear me okay?
Yes.
All right, wonderful. Yeah, I think the NMHC was very exciting. It was, to say the least, very exhausting. When you're talking to a lot of people, it pulls virtue out of you. But we had some really good connections with the Schreier and Brad, Semrock, and Alex and Ash. So I would say the conference overall, when you're networking and you're meeting new people, you're hearing their stories, you're getting to know them, I think that goes a long way because from my experience in working with people, you may not work with them in the next month or two, but you may work with them 6 months or a year down the road. And so you're building this relationship. So that's what I look for when I'm going to these networking conferences, is relationship building, seeing who's in core alignment with you, your goals, and me and Schreier really hit it off and got to know each other on a greater level. Another thing that I got out of it was just understanding and hearing the private equity. You know, a lot of these private equity companies, they want to invest, minimum of, $10 million or, 15 million or whatever the number is. But, they want to work with people who have a track record. They want to work with people who have maybe gone full cycle on a certain amount of deals. They have a requirement, just like we have an avatar. They also have an avatar as far as unit size, the class, the vintage, and things like that. So it was really good to hear what their expectation was as being an operator, to make sure that we're pursuing that and trying to give them a product that they want as well. So those are some of my takeaways. I would say another thing too is not this is my first NMHC conference, but having set appointments before I went was very helpful. I found this out from another owner operator who has a couple thousand doors that he wholesales and he sells to other people. But he said, hey, line up your appointments before you go. And there's a lot of local brokers here that I met here. I've talked with them for about a year. I've never seen them face to face, and NMHC was the place that I could meet them. And a couple of brokers sent me like 400 deals or 400 unit apartment complex. And so when I left NMHC and I flew out, came back home to Mississippi, my first stop was that property. And so it's just relationship building is what I really feel like NMHC did for me personally. So
we're not deal hunting. I remember I was in a room with a couple of the brokers, and one of the senior guys, he was like, yeah, I just picked up a 2,000 door deals right on the right from the session. So everybody has an avatar depending on who you are, what you're looking for. If you're intentional about it, you'll go get it.
Yeah.
Cool. Thank you, Frank. Appreciate
Yes,
it. Trevor, back to you, man.
Hey, good evening, team. This is my second massive capital, webinar, and you guys always bring the best to the table. So thank you. I'm based out of here in Florida, and I'm originally from Houston, Texas. So looking at quite a few deals, in the Florida market. So I know we all know there's a lag between where the sellers want their pricing to be on a particular asset versus where the numbers are really working, right? I mean, what are you guys doing at your end to make sure you manage that expectation, and and what strategies are you putting in place to make a deal work, right? I mean, we're looking at like quite a few deals here in the Florida markets, but there is that 10 to 20% gap. And even though regular discussion with the brokers are going, and they know the answers why the deal is not working at the expectation, right? Insurance is like through the roof, right? We are getting quotes of like $1,600 to $1,800 a unit, but still they're like, no, this it just frustrating. I know every market is a buyer's market, Shahryar, I agree with you, but we're not going to go into any deal, right? So So that's one thing I'm struggling with, like 3 or 4 deals that, we're looking at our end. So I don't know how you guys managing that from a expectation standpoint and from a frustration standpoint.
Sanjay keeps me in check all the time. I get frustrated quite a bit, right? So last 6 months, we underwrote 190 deals. We sent out at least 30 to 50 LOIs around that number. I forgot how many LOIs went out. So we try to keep 15, then 5 to 6 LOI and 2 under contract. That's the model. So frustration is given. That is not frustration. That is the nature of the beast. I'm on the road. I'm going to hit a red light. It's just the way it is, right? So don't get frustrated. Just get on with the saying that is the nature of the beast. And then on the other side, I love brokers, but at the same time, if you follow the definition of the jobs of the brokers, they are incentivized and they have a fiduciary duty to be on the seller side. They will not be on our side. Their job is to sell the property at whatever price that they can get away with it. That's their job. I fully support their job, right? When we hire a broker, it's the same thing, right? You go get whatever you can get out of it. So don't feel that way, but don't even beat the broker down either. You do you, they do them, make your offer, and you go.
Yeah.
If it comes through, if it does come through, the one thing we understand though, repetition and follow-up matters a lot.
Yeah.
Try to be the nagging guy, following up with that person, either cell phone, text, email, whatever the way. Continue, follow up, and when something happens, you are there, or you were the first time, or one broker says, it's the realism, right? When a seller, there's 1 or 2 sellers who will be realistic, they just want to get out of it, and you happen to be the first one on the line to take a shot, boom, you got it.
Absolutely.
Yeah. So just keep taking the shots. Don't be gun shy. Do your part. Brokers understand, and sometimes broker will not understand. I'll give an example. We had a property. I'm not going to name the name. Broker called. He got mad because you terminated because my insurance doubled from $650 to about $1,200. We underwrote it at a $750, underwrote at $900. Then capex came almost double, and we terminated. Broker goes in this. He has demeanor to tell us that, hey, I'm not going to give you a deal ever because you're terminated. And I was like, look, if I'm a brand new guy into the block, fine, I could suck it up. But I had to tell the broker in front of his junior associate that don't make those statements in front, because if you're a deal maker, you need to be very logical about it, not emotional about it. And ball is in our court, do my things. I paid my fees, paid my EM, and I moved on. That's a choice in me. So what I did in return, I called up the CEO of the company. I dropped the name on the team. Here you go. So you're going to have those brokers. You manage the expectation within lines. You're here to spend your money. You're going to go through the whole crap shoot everybody else going through. Does the broker give a crap? 0.
Yeah.
Did the lender give a crap? 0. You are in the hole with your money at all times. So you need to take care of you and what makes sense for you. So I am wholeheartedly, I support all the operators. It's a lot of pain we go through. So you got to make sure you're right. And brokers and lenders will be there.
Yeah.
Right.
Makes sense.
That's it. So keep making offers though. Don't be gun shy.
Absolutely. We have like 3 LOIs, but
That's right.
we're working towards striking a right price point for investors.
Yeah, that's it. And kind of play with it. Like we lost a deal in Denver. We underwrite at a 17 IRR, first pass, 1.9 multiple for the LPs. In Texas, we are getting close to it, but here we go, Denver market. People are underwriting at a 13, 14 IRR, 1.7 multiple, but they bet on the appreciation. We underwrite at a 2% asset management fee, and that deal that we lost, we happen to know that the cause of to raise equity, we didn't do it. We saw them underwriting at a 1% asset management fee, at a 14, 15 IRR, and a 1.8x multiple. Money follows Denver, and they like Denver. They want to go to the investment, is fine. That means that the way we structure a deal instead of Texas will be different than Denver. Your Florida will be different than us, right? So you have to adjust the model as you kind of go through.
Absolutely. Yep. Thanks
Thank
for
you.
your wise words.
David, you're next. You can unmute. Thanks for being patient.
Yeah, absolutely. Awesome stuff, guys. Thanks, Shriver, for that information. That's so true. I was out there at the NMHC. It's kind of a tongue twister, and I had a great time. I actually followed a broker out there, a couple brokers, and prior to that, one of the brokers, we broke bread together. We talked about the deal. He was on my side, I felt like, and as we continued on, he's like, "Yeah, come out to Vegas." We met up out there. but I kind of, I already came armed on what price point I needed to be at. Had reached out to my lender. They underwrote the deal. And it seemed that like everything switched when I met with him. All of a sudden, once I told him where we were at, got very emotional. Almost just like the date just turned real sour. And it's just one of those things. I even followed up with him again today. Pretending nothing happened, and it was like a date gone bad. But I enjoyed myself. I even met with you, and I kind of explained to you the situation, Schreier, and you gave me some good pointers and kind of started touching back on that with him, and we'll see where it goes. But nonetheless, though, I had a great time out there. It was very overwhelming for sure. There was a lot of people, a lot of brokers. I made a lot of connections as well, though. So all in all, I think it was a great trip, and had a good time. Can't wait to do it again.
David, so thank you. To kind of build up on that, the good brokers are good brokers. They're going to have fun with it. They're not going to have emotion into the deal. There was one broker I was chasing. As much I don't, I think they're tough. I chased the broker. I don't chase all the brokers, but I chased him for a certain deal last year. Happened to be the first day of NMHC. We're signing up. He was the guy right behind me. Then one thing led to another. Then he was looking me up. I was like, I have your cell phone number. I was like, man, where are you from? He was like, Houston. I was like, oh, did I send you an email? So he goes to the email and he sees that 3 emails that I sent in 2022. He didn't reply back. And I started laughing. He got the point. I started laughing. And he goes, excuse my French. He goes, I was a dick, right? I was like, yeah, you didn't reply. Now we both started laughing. And then we had a good conversation. You want to find those logical, level-headed, good brokers. They understand the downside. They understand the upside. They are the deal makers. When you talk to brokers, underwrite the brokers. We underwrite the brokers. I want to know how the brokers behave. I want to know how they underwrite. Marcus Millichap underwrites different than JLL, underwrite different than another brokerage company. Underwrite the brokers as much as you can, but good for those brokers. Been there for a long time. They're level-headed. They want to get a deal. They get the joke. They get the fun. They understand the position, and we play. And those emotional ones, take them out. It'll be easier for you to get some deals done. Those brokers are tough to work with because their job, they are qualifying us, right? But if you go to the validation or qualification, then those are the brokers who pay you dividend a long time. And I came home with the deal as well. So hey, that laugh, that joke, became a deal, right? So hey, no complaint.
So I wanted to say one quick thing, and it's a little bit on Balji's question before about creating generational wealth, right? He's very comfortable in the single family home space. But if you think about it, on a single family home, all your eggs are in one basket. And if your tenant moves out, anything happens, are you really safe and protected creating, right? Because it's on a multifamily, we all know, if you got 100 doors and 10 tenants leave, you're still 90% occupied, you're still stabilized, you're still producing cash flow. And so it's a mind shift, right? Because that's what you were comfortable with. That's how you built a lot of wealth. You came from California where land appreciated, came to Texas, land appreciated. But when that changes and you only have that single source of income, it may not be the best way to protect your generational wealth. Because we all know and we all talk about the value of multifamily as doing that, plus risk reward, right? It's a lot of energy to go buy a house. It's a lot of energy to deal with a tenant. It's a lot of energy to deal with a property management company. And no one ever says I'm going to go back to single family after they get into multifamily. But I see a lot of single family saying, I wish I'd have found, and I never did single family. So I never, only house I ever bought single was my own. And but I just want to make sure, that we got to be prepared for this, a little bit of a mind shift and then effort, right? As a passive investor, you're just vetting an operator and then you go ahead and do it. So I just wanted to add that last point. We got one more question and then we'll in theory officially wrap up and then we can keep talking till just if Char leaves, you can't ask any technical questions. So.
Let me add 10 seconds to it, Trevor. This is cool. But one thing about the single family is that it builds your confidence because whatever that you do, you see it really quick, 6 months, 3 months, 9 months, you see the appreciation, you see the rent increase. It gives you a visual, it gives you a taste. On the flip side, Trevor is 100% right. Nobody goes back to single family. I went from buying one single family to 7 to 17 to 34 to 76. It was a nightmare. I thought once you buy 20, I can hire more property management company, all those shebangs. Man, I hated that thing and I dread it. And so I buy single family to sell yesterday. That was it, but multifamily is the way to go. And just my 2 cents.
Vivi, can you unmute yourself?
Hello, everyone. I just want to know what your opinion is when, okay, I have a deal and we've done the first stage of due diligence, and going back on the second time, we asked for the rent roll. It felt like the vacancies increased tremendously, but the lenders are still willing to loan us money on this deal, and they're saying that the deal is a solid deal. But on our paper, it's not looking as solid as it was before. So my question is, when a lender is like wanting to fund a deal, what does that imply?
Oh, this is a sleeper. So I'll be getting into a lot of world of pain. So I'm not going to talk about, so I'll just give you data points, right? And take it the way you want to take it. Lenders are looking at on paper how much rent you're collecting and are they paying or not. As long as you book it, you're fine, right? On the flip side, we have very good sellers. They are ethical. They will do everything right. They manage everything right. They give you the books right. If they say 84%, 95% occupancy, that is exactly what it is. They run the asset from their heart. We have lots of them. On the extreme flip side, we have those assets. They fudge the number in just because we said you must have a certain amount of occupancy as you go. You got a hard bid? Get in. Don't have to pay me. Just get in because I can hit the number. So what I meant to say, the ownership is on your end. Lender is looking at that leisure and giving you as much information, whatever given to them, they will lend it. Then you also have to see what I providing to all the rent roll and the collection that you're providing to lender, whether it's right or wrong. That means, do I think the seller is playing? So when I go into the property and start taking over, I'm going to find 50% economic vacancy. That means 30% is not paying rent. What is it? And so you can ask for the collection slips right now. You can ask for a bank roll right now. They'll give you the deposit slip, and you can reconcile what does the rent roll says and what's the collection in the bank account. And then you can match that and you can make a judgment call. So if that's a class C, if that's a value add, depending on the size, if they always vary. So don't sweat over it, make an assumption on what the gap is, put that into the working capital, build your CapEx plan and see if the project works. So it's a good question. There's a gap between what the lender will lend versus what you're going to get in real life.
Yeah. Thank you.
Thank you. So I want to make sure everybody remembers we do this meeting every Wednesday night. It's different topics. We're going to try to announce out, I believe next week we're presenting a deal again, but it's going to be a mixture of deal presentation, education. Please invite anybody that you think would enjoy this. The more people that join, the better the questions, the better we all learn. Super, super important. We learn more from the questions probably than we do in the presentation overall. So so any other questions before, in theory, we officially call it? And we answered all the questions. It's pretty good when you answer all the questions in life. How many people are in the Texas area going to go to the MFIN this weekend? Awesome, I'll be there. Awesome. Any closing words, Shar, you want to?
No, I would say, hey, thank you. All I can say, thank you for supporting us. Thank you for investing with us and also participating in the Q&A. We really appreciate all the support that we had and we're going to have as we move forward. So thank you, everybody.
Yeah, sorry for the glitches getting on. Growing pains. I don't know what happened this time, but we'll figure it out. Awesome. Well, thanks everybody for joining. If there's no more questions, we'll call it a night and we'll see everybody next Wednesday night, 6 p.m. Central.
Thank you. Have a good evening.
Thanks, everybody.